Market sentiment on Wall Street is unclear. The stock market survived the annual bank stress test. Now investors are worried again. Today investors will find out some pieces to the puzzle, but the main piece will be available tomorrow. Since the beginning of the week, the market has been absorbing remarks by leaders of major central banks. They wrecked investors' faith in the monetary softening. In this context, the benchmark stock indexes went down again, and the high-tech sector helped the stock indexes to stay afloat. The Dow Jones lost 74 points or 0.22%. The Nasdaq closed in the green, having added 0.27%. The S&P500 closed almost flat with a 0.04% downtick at 4,376 points. The major stock indexes traded higher in the New York pre-market. They are gaining ground for the most part of the day, and the S&P 500 is expected to trade in the intraday corridor between 4,340 and 4,410 points. Wall Street came under pressure on Wednesday, and the benchmark indexes got trapped in the ranges after Fed Chairman Jerome Powell signaled further rate hikes and said he didn't foresee inflation falling to the official target this year or next. Powell also said at the ECB forum on Wednesday that the Fed is likely to raise rates even more and did not rule out an increase at the next policy meeting scheduled for late July. Powell's hawkish rhetoric will largely supported by his counterparts from the ECB and the Bank of England. Sweden's Riksbank was the latest to push for a rate hike on Thursday. German inflation data for June pointed to a worrying re-acceleration in domestic prices. The hawkish approach of the leading central bank, including the Fed, assured investors to revise their bets on the interest rates. The futures market gives an 81.8% chance that the Fed will raise interest rates by 25 basis points to a range of 5.25 and 5.50% at its July meeting, up from a 74.4% a week ago. Despite the overall risk of mood, megacaps helped the indexes avoid a significant drop and lifted the Nasdaq. Apple reached an all-time high during the session and registered a record closing high for the second consecutive session. Tesla, Microsoft and Alphabet have also led the S&P growth. Chipmaker Nvidia closed down 1.8% and became a major drag after the Wall Street Journal reported that the US may impose new restrictions on exports of artificial intelligence chips to China. Netflix shares rose by 3% after Oppenheimer raised his price target, and 4 of the 11 major sectors of the S&P 500 went up, with the energy leading up 1% and telecom services up 0.8%. The Russell 2000 small cap index added 0.5% for the third day in a row. On Thursday, futures for the US stock indexes were set to rise. Market optimism was fueled by the news that banks have successfully passed the Fed's stress test, and their capital is sufficient to withstand a severe economic downturn. This year's test, which was developed prior to the latest banking crisis, tested whether banks would stay above a minimum capital ratio of 4.5% during times of economic turmoil. Shares of the best test participant, Charles Schwab, grew by 2.2%, and major banks such as JP Morgan Chase, Wells Fargo, Morgan Stanley, Goldman Sachs, and Bank of America also added from a 1.2 to 1.9% before the call. Of the 6 regional lenders that participated in the testing, Bank of New York Mellon and the U.S. Bank Corporated increased by 1.5% and 0.8% respectively. Shares of Citizen Financial fell by 2.2% after the regional lender took last place. JP Morgan downgraded the bank's rating to neutral in anticipation of an increase in capital requirements. Citigroup's shares rose slightly but lagged their peers as analysts expect a rise in the stress capital reserve to hurt profit-boosting plans, while the largest U.S. banks remain strong even in a highly stressful scenario. Management teams are likely to be prudent on capital. Thanks to the stress test, the U.S. banks recovered slightly after a troubled start to the year. The regional banking index is up 6.04% this month, but still remains 24.5% below the previous early closing high. The S&P 500 banking index, up 0.9% since the start of the quarter, has stumbled by 12.2% this year. At the same time, banking optimism during the day supported the market and may provide support within trading, which cannot be said about macroeconomic data. On the one hand, the U.S. economy remains in a good shape. On the other hand, the labor market is overheated again. In the final estimate, U.S. economic growth in the first quarter was 2% year-on-year, which is way higher than the 1.3% in the second estimate, and the forecast over 1.4%. Consumer spending growth accelerated more than expected to 4.2%, the highest rate in nearly 2 years, driven by a 16.3% increase in durable goods spending and a 3.2% rise in services. Government spending was also revised upwards. The main negative impact on the GDP growth was provided by investments in private stocks and fixed capital of the residential sector. At the same time, weekly jobless claims once again hinted at a hot job market. The number of Americans who filed for unemployment benefits fell by 26,000 from the previous week's 20-month high to 239,000, the sharpest decline since October 2021, and the figure was below market estimates of 265,000. Jobs data went on Wall Street's optimism, but with a Fed's preferred inflation indicator for May due for release on Friday, investors may take a wait-and-see attitude. In terms of individual stocks, Micron Technology jumped by 4% ahead of the opening bell after an earnings report filled with optimism for an artificial intelligence boom. Apple shares edged up by 0.2% after closing at a record high yesterday and approached a market capitalization of $3 trillion. Shares of other high-growth companies such as Tesla and Nvidia are up more than 1% each. Walt Disney shares slipped by 0.5% after K-Bank downgraded the stock to sector-wide from overweight. H&M shares slipped by 11% to a 16-month high after its second quarter earnings beat forecasts. And later today, the market is waiting for data on the pending home sales in May and Powell's speech, and Atlanta Fed President Raphael Bostic comments. The fresh macroeconomic data encouraged the US dollar. Its index grew by 0.4% intraday to trade at 103.30 points. The index is likely to trade in the corridor between 102.90 and 103.5 points. The greenback has found solid support from Fed policymakers. All of them share their hawkish viewpoint, thus dispelling doubts about further tightening. The macroeconomic data also played into the hands of the dollar today on the one hand, and the index received support from another evidence of the stability of the US economy, which pushes the fear of a recession into the background. On the other hand, the hot labor market potentially can contribute to inflation growth and hence aggressive moves of the regulator. Given the mixed data from the Eurozone and the dismal economic activity, the dollar is gaining some edge before the European economy and in relation to the yen. Federal Reserve Chairman Jerome Powell, speaking on Wednesday at the panel with the Bank of Japan Governor Kazuo Ueda, said that 2 rate hikes are likely this year and did not rule out the possibility of an increase in July. On the contrary, Ueda said that there is still some distance to go to sustainably achieve 2% inflation, accompanied by enough wage growth to consider withdrawal of ultralight stimulus. In this context, the yen went to conquer new lows against the dollar, extending its losing streak. The yen weakened to 144.70 for the first time since November 10, losing a whopping 11.6% against the dollar since the end of March. The euro and sterling also lost about 0.3% against the American currency during the day. As for the Canadian dollar compared to other top currencies, it holds up quite well, but also retreats under dollar pressure. The USD CAD pair rose by 0.18% intraday to trade at about 1.3280. As for the intraday corridor, it's outlined between 1.3260 and 1.3320. Despite the large-scale growth of the dollar index, the loonie was able to rely on the hawkish mood of the Bank of Canada on Wednesday and a sharp increase in oil prices amid foreign U.S. oil inventories. Already on Thursday, oil market quotes stabilized. Brent crude futures grew by 0.3% to $74.31 a barrel, and WTI futures also rose by 0.3% to $69.81 a barrel. Both benchmarks gained about 3% on Wednesday after the U.S. Energy Information Administration said crude inventories contracted by 9.6 million barrels last week, well above analysts' forecast of 1.8 million barrels. However, concerns about the impact of higher interest rates on economic growth returned to the fore again, slowing down the rally. The pressure was escalated by the fact that the annual profit on industrial enterprises in China fell by double digits in the first 5 months due to lower demand. The crypto market is developing a rapid rally. Bitcoin appreciated by more than 2%. The token surpassed the 30,700 in the pre-market, aiming to break out $30,800 and $31,000. Most of popular altcoins shared market optimism. Ethereum, Solana, Ripple and Cardano grew by 1.8 to 10.4%. Litecoin and Binance shed 1.2% and 1.9% respectively. Binance had pretty good reasons for another decline. Binance's European banking partner, PaySafe Payment Solutions, said on a Thursday that it will stop offering its embedded wallet for the US cryptocurrency exchange in the European Economic Area effective from September 25. PaySafe and Binance are currently working to jointly implement an orderly and fair termination process for this service over the next few months, PaySafe said in a post. Binance will change the service provider for euro deposits and withdrawals through the CAPA single payment area, while the current partner, PaySafe, will no longer provide these services to Binance users. Interestingly, problems of the stock exchange didn't cause alarm in the market. Bitcoin, which is strengthening its dominance on the back of turmoil, continued its efforts to get out of the trading range of 29,700 and 30,800, so the forecast is unchanged. A breakout of the lower border may lead the price to the correction below $29,000, and in a case the upper border is broken, the price will head for $31 or even $31,400. So that's all for today. We wish you profitable trading. Make profits with the InstaForex. Subscribe to our channel and see you online later.